All right, Peter, we're live here, and the subject that we wanted to talk about today is adding to businesses that we are intimately familiar with during a period of crisis. And as we've talked in preparation for this call, there's been a couple of instances over the history of our investment partnership where we have had stocks that we feel very comfortable with, that we bought at what we believe to be a discount, drop off big time in price because the overall market experienced a major market event, right? We can go back to 2020 with the pandemic. You could go back to the global financial crisis, but what we do and how we behave in those periods of intense uncertainty is the topic that we wanted to discuss today. So I'll let you add some thoughts in terms of what we're talking about here, and then we'll go into some specific examples.
When we're in an element of crisis, and of course, the yin and the yang, of course, this crisis also represents opportunity. And so when we're in a crisis period like we were in 2020, or back in 2015 with the price of copper, or in 2023 with housing starts, it feels in many ways like the end of the world. And you have to really be intimate and strong with your conviction if you're going to add to something that has lost 40 and 50% of its value from a price that you felt already was discounted substantially. You do run a tremendous risk, though, of in 2020, as an example, many restaurants went out of business and you went to zero. So we want to make sure that we are intimate with a business and that it's strong financially, and so that we don't have a zero, because that basically destroys the investment. And by the way, our record is not perfect. We have had some investments that have with COVID in particular, where the investment lost all its value because of the crisis that we were in. But it's really, that's why we have a diversified portfolio. Now it's a concentrated portfolio, but a diversified portfolio, because the ones that win out win really big for you, and the ones where you lose, you lose your initial investment there.
Right. And we've talked in previous calls about what it means to be diversified, and our definition of diversification is not the efficient market hypothesis definition where you own 60% stocks and 40% bonds and you spread them out through index funds, but instead we follow a concentrated stock portfolio philosophy where we believe that the companies we own all carry decidedly different risks from one another, such that they're not going to behave in sync with one another. We have a true diversity of outcome. And why don't we focus on one investment that we haven't talked about in a while, that really represents this topic very well, and how we were able to take an investment that we had high conviction in that hadn't really panned out as well as we had hoped, right? Our optimism was high, but it hadn't worked out so well. And then it really got hammered in 2020. And the investment that I wanted to talk about is Tanger Factory Outlet Malls. So why don't you give us a little history on when we got started with the investment in Tanger, and then what happened to it in 2020?
Sure. We actually became interested in 2015 with Tanger, and we made our initial position somewhere in the high 20s. And it was a real estate investment trust that had about 35 malls near highways in various main cities, and they were factory outlets. So it was Tanger Factory Outlets. And that company had gone public in the early 90s and actually had raised its dividend every year since it had gone public. So it was one of the what they call maybe the dividend aristocrats, that had a terrific track record there. Um, and when COVID came along, Tanger was forced to close all their outlet stores, and so revenue went from several billions of dollars to zero during that time period. And it obviously was a crisis for all of us, but it was a real crisis if you're suddenly put out of business, which they were in that case. And the company did everything they could to batten down the hatches very quickly. They immediately went and borrowed on their line of credit to the max. They eliminated their cash dividend, and did everything they could to see if they could get those businesses reopened as an emergency type of thing, which they were not successful at. So the stock price then, it was almost a delayed scenario because it didn't get hit that hard until some of that additional news came out where they were permanently closed. But by August of that year, the stock price was lingering down about $7 or $8, down from 25. And we would add to our position there, and then within a few days, it's down to 6, and then 5 and 4. And if you look at your statement a month later, where you added to it at $8, it's now at $5. You look like an idiot because you've lost an awful lot of money quite quickly. But by staying with it, ultimately, they reinstituted the dividend as they reopened those outlet malls, and began to start increasing that dividend again, and got over the consequences of that. And ultimately, we decided to sell out of that position last year at about $36 per share. And the individuals who bought it at 25 had a good gain because they were getting about a 5% dividend on that, and a growing dividend. But the ones who bought it at $7 and $8 and $9 per share had really the oversized returns. And that's an important part of being a value investor, is you got to step up to the plate when the bottom drops out of the world. I didn't say you're not scared to death, because it really does feel like the end of the world. And so you really have to have strong conviction. And so that's why it's so very, very important that we already have an intimacy with the business, and we're willing to add to it during those crisis moments.
Yeah, so often we see in these periods of crisis that the overriding sentiment is to sell first and ask questions later, right? So we own a mall operator, and everybody's been forced to stay home, and malls have been forced to shutter, and people hit the panic button, and they fled for the exits, and they sold off the stock, and the stock sold off. I mean, for a company like that, a company of that scale, to lose 70 or even close to 80% of its value, that drop happened over the period of just several weeks. It didn't take long at all. So to talk a little bit more about what you're feeling when that kind of a situation happens, and what caused you to not sell first and ask questions later, but instead make the really tough decision to add, or double down, or in some cases even triple down on the position.
Well, one of the things is, you got to remember, as a business, we are helping our clients financially plan, and then we're also doing research and purchasing securities. So we're really, in all intensive purposes, have two diverse operations in the business. Now, as financial planners, you become a behavioral coach to clients and say, I don't know how this is all going to work out, but in the past, it has ultimately worked out. And I urge you to stay with your investments and not bail out. And some clients will bail out, but the majority will listen to behavioral advice. But you can't begin your behavioral advice when the crisis starts. That has to begin at the very start of the relationship with the financial planning, and to let them know that from a financial planning, we're on a journey to Australia and we're leaving from New York. And I guarantee you we're going to hit bumpy waters and we're going to get there just fine as long as you don't jump overboard. And so when it comes time when we're in crisis mode, we make sure that we mention that to the clients that we've had this discussion. And it's not a one-time discussion. It's a discussion over and over and over and over again so that our clients are well aware that we actually expect those and they become opportunities for us as opposed to crisis. If you go back to the year 2008, Warren, in October of that year, Warren Buffett wrote an open letter to the New York Times. And in that letter, he said, yeah, I'm scared. The economy is down significantly. I don't know how it's all going to come back, but I have confidence that it ultimately will come back. And I'm buying U.S. stocks at the moment because I believe in that. Now, we did not hit bottom for another 6 months. And the investment that he made in General Electric that had a conversion price of about $20 per share, I believe went all the way down to about $6 per share. So whether you're the greatest investor in the world or other investors, just because you're buying something at a huge discount does not mean it can't continue to drop dramatically. But you have to be willing to step up. But it feels like the end of the world. And I don't know, maybe it's something a little bit different about my personality, but part of it is that we've made such an effort to read about these types of markets in the past so that when they hit, we know it's another one of those.
Right. There's actually a lot to unpack there. It's funny you use the boat journey to Australia as an example because very often when I'm speaking with clients, I will tell them, these are our lifeboat drills, right? And why do you do lifeboat drills? Well, it's so that there's less panic when you hit those rough waters. You know what the procedure is, and you know that there's a plan in place already for when we've hit rough waters. So in the case of COVID, when everybody panicked, and I think the market sold off 34%, the broad market, the S&P 500 sold off 34%, starting in February and ending at the end of March. And it was really, sell first, ask questions later mentality that was going on. We held tight, but we didn't just hold tight. We got on the phone with all of our clients. I remember you were trapped in a hotel down in Florida, and I was at home at my house in Rochester, and we locked ourselves in our rooms and we made phone calls and phone calls and phone calls, and we got on the phone with people and we explained that we never know what the storyline's going to be, but we do know that we are going to experience periods of intense volatility like we did in 2020. And it's really an opportunity to step back and say, let's take inventory of everything that we own. It's important to note that not all companies did recover from that, but when we own a high quality business with stable cash reserves and capable managers, and we have lines of communication into that company to know what's going on, we are also doing the behavioral side of the business in terms of being ready to take advantage of those periods of crisis and use them as the opportunity that they are. But why don't you talk a little bit about what happened to the people who took our advice and added to that position in Tanger when we finally did sell out last year?
Sure. So I had a couple examples of an individual originally purchased the shares at $32 a share in June of 2015 at $32 a share. And we decided to add to that in 2017 at $26 when it dropped off. And then we also added to it right after the COVID crisis hit. And we bought some stock at $13 in February of that year. And then in August, we were able to purchase some additional shares at $6.16. So we sold out of that position last year. The original position, in addition to all those years of dividends, grew by 8%. The second position grew by 35%. The fourth position grew by 170%, and the fifth position grew by almost 500%. And so you can see that continuing to purchase throughout that crisis created a tremendous opportunity for those individuals to benefit. Um, so, at the same time, we also owned a company called Kimco, which we added to. But there was a big difference between Kimco and Tanger in that Kimco was not forced to close its malls, and so they continued to do business and benefit from that. So you saw a price decline, but not nearly to the same level you saw with Tanger. And so yes, we had an opportunity with Kimco as well. But the ultimate results were a whole lot less because the the feeling of desperateness was not nearly as great as it was with Tanger.
Well said. Um, so we talked about an example here with Tanger where the overall market had declined. And when the overall market declines, everything tends to correlate, and all of the positions that are equities that we hold tend to behave in a similar fashion during that decline. But there's also instances where you might have a sector or in our case here, a commodity where the price has done the same thing. And we wanted to talk a little bit about Capstone Copper, which was another instance of the same type of story playing out, but specific to the copper market.
Yeah, the copper market had peaked in about 2011 at about $4 for an ounce of copper, and then it started to decline. And by 2015, it was down in the $2.30 area approximately. And I think in late 2016 or middle 2016, it peaked at probably maybe just about $2. And most copper companies are at best operating at a loss at break even in the $2.20 range, and probably operating at a loss when it hits the $2 range. And so you're you get tremendous sell-offs in the value of those companies. In the case of Capstone, I believe our original purchase was they had a net worth of the business of about 2 billion, and we were able to buy in at about half a billion in value. It was trading at about $1.23 in May of 2015, and it continued to decline. And this particular client, we purchased some additional shares in June of that year at $1.03, and then we purchased some additional shares in September at 47 cents. And I know it went all the way down to 32 cents after that. But we fast forward, and we didn't sell that for we're very long-term investors, and we sold that last year. So it was basically a 10-year holding period. But the original investment was about a 5x. The next investment was a 6x, and then the other investments were 15x's. So you had by adding to the position as it declined there, you did incredibly well. And also, if you look at the price chart of copper, it had bottomed shortly after our purchase in the 2016 between 2016 and 2017. But after that, it had a rise, and by last year, it was trading well over $4, almost pushing $5 per share. And yes, we sold out at about $8 per share, and I think it continued going up to about $12 per share. But we were quite happy to take our profits where we did, and go from there. To say that you're going to hit something at the extreme bottom and get out at the extreme top is very wishful thinking. In reality, virtually impossible to do.
Yeah, I think you and I have talked about like the plight of the value investor being we tend to get in a little bit too early, but also get out a little bit too early. But that's because we're very price conscious, right? And so we're in early because we see this major disparity between the value of the business. You said Capstone, the value of that business was about between a 1.5 billion and 2 billion. And then we had the opportunity to buy it for 500 million. Well, we didn't know it was going to continue to go down, but we knew it was worth a lot more than what we had paid for it. And then we didn't realize on the end of that, that, copper prices had gone way up beyond what we thought that they should be. So we sold out in fear that copper prices were too lofty, and they continued to rise. But by holding during the bulk of that period, we were able to obtain substantial gains. As we talk to our clients and as we share our pieces of our investment philosophy with people, the idea that, we're going to get the timing right on everything is never the focus. It really is about being able to make investments in companies that we are intimately familiar with and that we realize we're buying them at a discount when we purchase them. But that doesn't mean that the discount doesn't continue to expand, or we don't get shocked by some factor that we weren't ever anticipating. So just talk a little bit about how do you keep your cool as an investor when those things happen, and why has that been such a successful strategy?
I think the key is our core value of continuing to learn. Because markets tend to repeat themselves. And while they don't exactly repeat themselves, they do rhyme. And you can see things that it becomes another one of those. And when you see another one of those, it gives you the opportunity to act in a manner that is appropriate, and it makes sense for the client. It doesn't mean that you're not fully scared of the situation, but you have to have the courage to move in the opposite direction of what other people are doing. That's the core of being a value investor. And I think with the continual learning approach that we've taken, we've spent tremendous amount of time studying about the various markets of the Nifty 50, the .com era, 2008, back in 1982, 1987, 1992, and all the many crises and things in between, so that when one arrives, we realize that here's an opportunity as opposed to a reason to panic.
Well said. Well, I appreciate you spending some time with me to go through a couple of historical investments that we've made and hadn't covered on one of these calls before, and relating that back to the process that we hope our investors are listening to these calls and learning from them, and that we will continue to share bits and pieces of the investment philosophy that's led to our success as investors, in the hope that our clients continue to buy into that philosophy, and when the next crisis happens, that they're on board with us and viewing it as an opportunity, not panicking, not to say that they're not worried, but knowing that this too shall pass, and that if we follow the disciplined approach that we built and that we systematized, that there are incredible gains to be had when you act according to the plan.
Thanks, Justin.